Hey guys, this is Jay Hughes, and excited to be with you today. I'm going to get to introduce right now my guest, who is a mortgage and real estate industry leader, and really what I would say a true pioneer in this business. That's my good friend, Jim McMahan. Jim has been a force in the mortgage industry for the last 30 years. He was a street level originator where he closed in excess of 5,000 transactions for over 1.5 billion in volume. That's personal production. All the way to his current position today as the president of Benchmark Mortgage, which is a position he's held since 2008. Jim has built his reputation on the ability to help mortgage professionals grow their skills as well as their businesses, especially in tough markets. So Jim, man, appreciate you so much, and I'm super excited to talk to you. So first, just thanks so much for being with me today.
Yeah, man, thankful to be here. I always enjoy our ongoing fireside chat conversations, brother.
That's right. That's right. Okay, so you and I were on the phone, well, several times over the last 30, 40 days. We've had some conversations to kind of prep for this discussion today. And so with that listener having that in mind, okay, coronavirus had hit, we're 30 days in. You had told me, Jay, it's just so interesting because it's like we're in the greatest volume market ever, and yet and companies want to make money right now, but at the same time, it's like they need to stay alive and use this picture. You said, Jay, there's bear traps. There's these bear traps that are out there, and companies have got to try to avoid those. So let's start right there. Like maybe let's look back over the last 30, 40 days and just cue us into your perspective on some of these bear traps that existed and maybe still, and obviously do still exist today.
Yeah, that's good. And it's been fun. And, we're now, to date everything about to start in June. Summer's here. Amazing 90 days that we've all experienced together in our industry, personally and professionally, in our country and communities. And so this really is a great time for our core to go out to folks, I think, just because of perspective. And you know me well, I'm a big perspective guy. It's hard to believe I'm my 34th year doing this crazy business.
Yeah.
Because, it's really an industry where, in a business where many times you get stuck in a cycle of asking the question, am I doing this 1 year 34 times in different challenges and craziness like this recent one, or have I actually progressed and grown myself, my business, my practice, and understanding, over a period of 34 years or 20 years or whatever your story is.
Right.
And hopefully many of you will be like mine where you've actually grown and learned. One of the things, too, I mentioned to you last time we talked, someone asked me when all this was kicking off pretty hard in March, because that's when that week to 10-day period was when the Fed started buying unlimited mortgage backs, which we'll get into, and swung the yield sometimes 3/4 in a day on real rate, which actually damaged the industry for a week or so. Someone asked me, gosh, this is crazy. Have you ever seen anything like this? We've never had anything that's happened before. And I said, well, actually, to date myself, this is my 7th crisis in 34 years. But, we haven't had anything happen in the last 10 to 12, since the 08-09,
Right.
Obviously meltdown in global or United States recession. And it affected the globe then too, but it was very, very different. This is something that's just fascinating still. I'm a real student and historian of the business, and I look at the reality that on March 1st we were in the greatest economy any of us on this phone call have ever been in, for sure. And you can you can see that more than ever now as you look at the reality of how resilient the economy still is, even with 36 million people out of a job since March 14th or since March 14th. So there's some fascinating things I just want to point out. I'm pretty good at stating the obvious, Jay, but I think it's important sometimes for perspective.
Yep. And
so to review and then bring us to current, what happened in March and early April was fascinating because we did do a purposeful shutdown of a third of the economy in, trying to obviously make a difference, flatten the curve, all the things that it looks like we have done now as a country with this virus, even with the political crap and all that going on. I mean, most communities have done an amazing job. I'm in Texas. We've got things going again pretty good, and et cetera, around the country. I think that'll continue. But all that to say, with the industry, what was learned at that time, and I call them bear traps, you learned a lot about your lender. You learned a lot about your company, and we're using that as a campaign now in our company.
Yeah.
Asking vendor partners, realtors, builders, very proactively, what did you learn about your lender? What did you learn about us through this coronavirus experience so far? Because you were clear after this one what a broker was or is, what a mortgage banker, large or small, is, what a mini correspondent lender is, what a bank is, large, small, and then what they were invested in. If someone was doing more jumbo than not, they got whacked harder in March.
Right.
The jumbo market still 70% of jumbo lending is still not there and won't be for a while. It's back with the big banks now. So a lot of subjects right now to talk about and what happened. One of the big issues I'll remind people of too, the refinances have certainly saved a lot of people's careers in our business and made folks a lot of money the last several months. And it's been exciting because, we've been able to help a lot of people. I will quote my good buddy Steve Harney. I love plugging him. He always plugs me. And very, very dear friend for a decade and a half. Steve has Keeping Current Matters, and he and I have done several calls through all this as well. And Steve always reminds the realtor community, as I do the lending community, combined, when you take realtors, mortgage loan officers, the lending industry, housing overall, builders, et cetera, we're 42% of the GDP, the gross domestic product of this great economy in this great country. And so it's incumbent upon us to help lead us out of recessions, small, large, or short term, like we're in now. And part of that is refinancing. But one of the big things that people may not have known, it's just a great factoid to know, Jay, is this was an April 1st statistic, but it's still relevant right now as we go into June. The 1st of April, and at any time nationally, there's about $13.5 to $14 trillion of mortgages on the books, okay, in our great country. That's how many loans, over the years we've all created, real estate sales, blah, 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 refinances. Well, okay, as cool as that number is, that's a lot of loans, and that's a big part of the economy. Just think there's a third of homes or more that are paid off free and clear, too. So
sure.
Our industry is huge, 20 trillion plus. Okay, so here's the real amazing stat. Last year, in 2019, our industry did $2.1 trillion in residential loans. It was a record year. It was amazing. We had a record year, a benchmark. Many people listening had their best years ever, and good for all of us, right? Because we helped America again. We helped our families and companies. It was a great year. Well, now jump forward to when March happened and the COVID thing really hit. Everyone was scrambling and doing what we did. Rates fell a lot, as we know. Rates were falling in late February as the market started shifting and reading into what was possibly coming. And, of course, we really knew by March 14th. But all that to say, many of you may not realize that by the 1st of April, there was somewhere between $3.5 and $4 trillion in the United States in line trying to get refinanced somewhere in America.
In process.
So more than, almost 2 years worth of the best year ever at one time trying to get refinanced. That wasn't just and then here comes purchases too that we're trying to still keep going in markets that could. And by the way, in a few week period where thousands of lenders that wanted to have their best month ever and have their best moment ever had to stop lending because of their cash situation, because of how they were structured, because of a lot of reasons. I've done about 20 Zoom calls now over the past 60 days with some of our branches' best realtor teams and builder teams. And I was talking to a group through Zoom a couple weeks ago across part of Colorado, and one of the realtors popped up and asked some really good questions and then said, wow, you just really helped me, Jim, to answer something. She said, I've talked to a lot of people, and I've gotten 10 different stories from different lenders, and I thought like maybe 1 or 2 of them were truth and 8 of them were lying. But she just like this person says, you just helped me understand there's actually was 10 different stories that were all true. And let that sink in for a minute, because there is many different ways people were structured, how much cash they had, or if they were a mini correspondent with a warehouse mini line with Wells or U.S. Bank or some of the people that have those kind of products. For someone to be a small quote unquote mortgage banker, everybody in different ways got whacked differently and hard, and there still is today. Thousands of lenders out there. And let me quantify. I'm a pretty big kind of numbers guy. I'm fairly accurate on my stuff. I read and study, and I'm obviously president and owner of a company now, been in the industry for years. But if you don't know this, roughly in America, in all 50 states combined, if you combine everybody that lends on a home loan, from brokers, bankers, mid-size, all the stuff I said, banks, savings and loans, et cetera, credit unions, there's about 34,000 lenders. 34,000 is the rounded number. And that's a lot, but hey, 2.1 trillion last year, all the stuff that's going on this year. But in the peak there of the wound and the bear traps everywhere in early April, late March, there was thousands, like 15, 18% of that 34,000 number that were either not lending, had parked it to the sidelines. Half at least or more were affected. And then all of us were affected, of course, by no matter how much cash you had, because we're pretty well capitalized. We made some pivots in structure, but that's a bigger point is even if you were in good shape financially, you hit walls late March and early April where the normal good guys that were buying loans, be it Wells, Chase, Citi, PennyMac, more the mortgage banker side, they were having days where they would bid on loans that were 3/4, 7/8 a point lower than normal, or you go out one day and have no bids from anybody. And now can you keep those loans? Can you not? So if you didn't know totally what was going on with your company or your lender, that's what was going on. There's some of that still happening, although obviously there's way better liquidity, way better clarity in the marketplace now, but there's still a lot of wounds and bumps and grinds.
Hey, Jim, real quick on that. Part of that is because, obviously it's been to say that there's been a capacity issue would be the biggest understatement ever. 3 to 4 trillion in the pipe trying to get pushed through. So now is that part of the reason why liquidity is less of a challenge today, because we're past at least a significant chunk of that bubble, capacity bubble?
Part of it, yes.
Yeah.
Part of it is yes, because loans have gotten funded. Companies have made money. That money can go back in the coffers.
Right.
You can either go extend your warehouse lines, because most banks and warehouse lenders wanted no compromise. They wanted more cash. They wanted to see more strength in your lines, or they were cutting you off, basically. Right. But also, the Fed did a brilliant job. This administration, the whole thing is, you can play all the politics you want. Look where we are right now with 36 million people out of work. The Fed's done a great job. Now, they came in a little hot and too strong in March, which we can go in that if you want or not, because it's yesterday's story now, the margin call issues and all that stuff that hurt a lot of the healthy mortgage bankers like the space we're in for a while there. But then the Fed hurt us, and they regulated, and they went from buying unlimited in the third week of March, and that's when we had the big swings of rates moving 3/4 in a day and 280 basis points one day, and millions of dollars in margin calls going in and out, which was an unintended consequence we didn't even need. It happened, but anyway, the Fed moderated that, went from buying 40, 50 billion a day to now they've set limits on 10, 12 billion a day, and they're not even buying that much because the free market's taken back over. And most of it, even though the Fed's in there buying. But the bigger issue is the liquidity piece to keep the purchase side going. What a lot of people don't realize, even good mortgage bankers out there that know the rules and guidelines, loans have to flow. The velocity of money must move for the lending industry to work, right? And there's a couple parts of that. For instance, Fannie Mae, Freddie Mac, if you are a direct seller and can service like we do, and thousands of lenders can, but Fannie Mae, Freddie Mac, those guys in their mandate, they can't service. So they package and sell loans and then, let people service that are approved to do that. So they stood by and bought the loans that definitely created liquidity. That part was very, very important in the puzzle. But the pricing of it, of course, was all over the place back then. And then you had Chase, went to 680. Everybody else went to 680. We're still at 680 on the new FICO for now. But some folks like Chase have gone to 700. Just because their volume is so enormous, they don't have any capacity to have any more come in, right? So there's still capacity issues. Yes, that bubble moving through, and part of it has helped create some liquidity. The Fed has created quite a bit of liquidity. But let's be real here. When we get the unemployment number for May, which will come out next week, we're going to be at somewhere between an 18 to 20-something% unemployment rate, bigger than any time in the Great Depression. And although some of those folks will start going back to work, hopefully soon as the economies open up, there's still going to be a lasting deal for months and months, because this is not going to be quick. And so we've got to be real careful. People ask me all the time in these calls I'm doing, well, when do you think we'll get back to a 620 FICO? I mean, a year, maybe a year and a half. I mean, could be a little quicker. You're going to have exceptions. Like, if you can service a loan, you can technically do a 620 loan right now. We're doing some, between 620 and 680. But obviously, if someone had a late payment in December of 19, we're not doing that one. But if someone's got a story and the credit was 4 or 5 years old, I mean, all the good lenders on this know this. But then it's a different deal. You can deal with some of this stuff. But anyway, I know that's a long answer to your short question. Just the bigger picture is it's still scrambled eggs. There's still challenges. It's a great time, though, Jay, to transition to this part of the message. It's a great time to be a pro. It's a great time to be really a student of this business and really go work hard on your craft right now and really practice being a professional mortgage banker and knowing, what the answers are. And if you don't, or if you're not spending an hour to 2 hours a day right now, reading, listening to good videos, like every morning I start my day after my quiet time and I get on CNBC and I do my videos of any economist that morning I wanted to watch. I listen, I take some notes so that I can do my calls for our team and our company. And all that to say, this marketplace needs pros that have great advice about the truth of what is going on. If that makes sense.
Oh, absolutely. Yeah, no, absolutely. And actually, well, so I have an idea. I'm sitting here thinking like it would be, and maybe this could be an offline discussion, but I know there's people listening right now thinking, I'd love to know exactly what Jim was reading or listening to this morning. So I have a couple ideas on that, but yeah, it's like right now, to be a pro by definition, you have to be an expert. You got to be an expert in the industry. Typically, at least my advice to the folks that I coach is you need to pick a specific segment of the business to be an expert in. But part of that means you got to arm yourself with the most current information. And so I think that's a great takeaway for some of you that are listening today, because it's easy to fall into a pattern of like, look, I've got file review with my loan officer assistant this morning, and then I've got applications, and then there's problems, and so it's easy to jump into something where it's like you haven't spent any time really studying your craft and investing in yourself in that way. So I think that's a great exhortation.
Yeah, and I'll answer the question, on the part of what do you read. For me, the term I've used for years, you've heard me use it when I was on stage a lot and all that, fiscal literacy, becoming more fiscally literate so that you can speak to the situation that are happening in the financial markets and in the mortgage industry, I think is a big, big deal.
Yeah.
And for me, CNBC is a great source. Fox Business is too, like Charles Payne a lot. But what I've taught my students over the years and some of our people is if you start watching, even in the morning, watch Squawk Box for a little bit, but don't just listen to all the rhetoric. When they have guests on, specific guests that are economists, like if they get J.P. Morgan's chief economist or B of A's guy, that you find someone that what they just said makes sense to you. CNBC's got this thing called CNBC Plus. It's pretty cool. You can subscribe to it. And then at the end of the day, you can search like that person, you understood what they said. And you can watch the videos of the interview throughout the day of a certain economist or someone who's a housing expert. Diana Olick on CNBC. I watch her videos all the time. I just posted one to our company yesterday of her video, quick snippet on Wednesday morning that she did with the quote-unquote amazing, surprising purchase numbers that came out Wednesday morning, being way higher than everybody thought on purchase applications in the last 2 weeks. and that was a great one I sent out to our company so that they could use it with their realtor and builder partners, of the pent-up demand terminology that's really, really out there, and how that has shown up just in the past 2 weeks. So, it's just making yourself disciplined to read and find the good resources. Obviously, the world today is overwhelmingly full of good resources, but it's choosing the right ones, and those entities I just mentioned are the ones I use, and then I look for specific, people or folks that are very, very credible. I like listening to J.P. Morgan's. I can't think of his name right now. I can picture him on CNBC all the time, but their chief economist, you can look it up. Goldman Sachs guy is really good. There's several, and when those folks come on, they usually have really good things to say, and then you can take that, turn that into your scripting, and use it with your people,
Right.
To get a more reality-based truth on what's going on right now. For instance, that's where I build my opinion on interest rates. And one of the things I would challenge the listener right now, too, is to ask yourself, do I really have a valid market opinion right now? Like, does my valid does my market opinion make sense, Jay? Or is it just sort of something I'm coming up with from a feeling I have? And, if you're just coming up with something from feelings, the old song Feelings, we're not on a date, we don't need just something off of feelings. We need facts. We need strong opinions. If you go to a doctor because you have a serious issue, or one of your kids does, you're not looking for somebody's warm feelings. You need facts. You need really strong opinions. And so that's one of the things I would challenge people right now to work on, a very strong, relevant market opinion based on facts as they are and how they affect the mortgage industry, home buying. And I can tell you right now that whatever little lull we might see, or a pause in the market, from what we were going into, which would have been the greatest spring market in any of our careers, I guarantee you could see it. It was already coming. And we're seeing it now, because look at the pop. I'm sure other people listening are seeing it too. There's been a pretty good little pop in purchase activity in the last couple of weeks in May, just from when the economy's opening up and realtors showing houses again, appraisers back in homes and all that. So does that answer the question, though?
No, I think clear
enough on the.
Yeah, no, I think exactly, and I think what we're talking about here. This is what I would call a framework. With folks that I work with, both individuals and groups, I talk a lot about trying to build your own personal framework. Which what I mean by that, like in the context of educating yourself with regards to becoming more financial literate, to use your phrase, that would mean investing time daily, reading multiple opinions. Of course, if you're brand new to that, it's going to take you 30 days to kind of become familiar with it. But if you like anything else, if you spend time at it, you're gonna grow. Your expertise is gonna grow, and the framework would be being able to take multiple sources of information and be able to translate that, then using your language, your frame of reference, your viewpoint, your opinion, and be able to translate that to people, whether that's your real estate agents or that's your prospective clients or whatnot. And it doesn't mean that you have to pontificate and that people expect you to be able to predict the market. Nobody does that. Nobody does that perfectly by any stretch of the imagination. But to your point, you've educated yourself, you're literate, and so you can speak in that. At least that's what I would say, Jim. That would be a valid market opinion. I'm well read. I can speak with I can speak with some level of authority, because I'm not just following one person, but I'm taking information and being able to disseminate that, distill that down into an intelligible way that's valuable for people. That's a framework.
Let me give you an example. Everybody asks me on these Zoom calls I'm doing for our top realtor and builder partners around the country, well, where do you think rates are going to be in the next 3 to 6 months, 6 to 9 months? Well, I have a really good answer for that, because I've really studied and I really listened. I've really built a market opinion over time. And I just go, well, I think they'll be a little higher and a little lower. Rates, yes, they'll travel in a range, but the foundational thing that moves rates in a long-term direction over time is inflation first, real inflation or lack thereof, and the threat of it. And then that's spurred by, obviously, economic realities and activities. In other words, you can look at unemployment. You can look at growth in GDP, and then inflation. And if you have those three components, just those three, I mean, if there was three ingredients to make the perfect pie, Jay, you just made the perfect pie.
Well said.
And so I study those three things, and then I can come out and tell someone very confidently, and I'm usually pretty darn accurate over the years, and how I built my credibility, my speaking years and consulting years, was being able to talk about rates within a range. And so when you look out right now, the biggest thing that's going to push rates up at all in the upcoming months is supply. And supply meaning, I'm sorry about that, I'm in a spot here where I'm getting my you have to cut that out, but my car's beeping. So, but you look at supply, and supply meaning that we literally just wrote over $6 trillion in bills to help stimulate this economy and help people in saving jobs, right?
Right.
And so, the government has got to go float bonds. We just announced, the government, you may not see this stuff, but if you're watching the things I'm talking about, you'll start seeing it in articles and different things. We just announced we're going to float $3 trillion in bonds into the bond investment market in the upcoming months. That's a lot. Like the old adage, how to eat an elephant one bite at a time. You're still going to be, overweight and have indigestion when no matter how long it takes to eat that elephant. So the market, when yields backed up a little bit in the last week or so, it was because of that announcement that a lot of y'all may not have seen, about $3 trillion being floated in the upcoming months to start paying for some of this legislation. Now, that backup in rates will be short term. I can guarantee you. Imagine someone guaranteeing something on rates. But the reason I can guarantee it is because when you look at the overall economy and the reality of what I just said, that we are basically in a situation where inflation is flat to declining right now. Not to say we won't have some inflation later. It's another question people ask me, well, isn't all this stuff the Fed doing inflationary? You bet it is. They are literally trying to inflate an economy. Will it cause real inflation down the road? Unlikely. Remember the TARP program and all that from 08, 09. Everyone said, oh my God, this is so inflationary. Well, yeah, it took them 4 years trying to inflate this economy. But then once they got the economy going, they were brilliant in how they pulled it back off the table and limited and lowered their balance sheet back into a healthy marketplace over the following 2 or 3 years. See, those are all things you can tell. I actually understand this, but I read, I listen, I discern, I take notes, and I study it. And so that's what I would just challenge everyone to do, is start to develop that market opinion by listening, learning, reading on those simple factoids of what's happening in growth in the economy, what's happening on inflation, what's happening on employment. And those three key ingredients will help you build a very valid market opinion where you can talk very confidently about mortgage interest rates and rates overall and their general direction, Jay.
Excellent summary. Yeah, I mean, that right there is a framework. How you just describe for people how they can arm themselves with information and really become an expert so that they can then teach. Okay, so you still doing okay on time? If so,
great.
Yeah,
fantastic.
I wanted to ask you. So we talked about forbearance, and so I'll leave it at that. I'll pitch that to you as the talking point. Talk to me about your thoughts on forbearance right now.
Yeah, it's an important topic, and obviously we're probably in chapter 3 on that topic now.
Right.
When it all started up in March. Because I mean, you look back, it's just like again on the COVID thing and the coronavirus. I mean, every life's precious, but my gosh, in March they were talking about 1.5 million people dying, and 100,000 versus 1.5 million is a big difference, right? Well, back in March we were talking about lenders maybe missing $400 billion in house payments over a year, and I mean, you're talking about an industry partially being wiped out where there'd only be the big banks left, if that happened.
Right.
Well, that obviously didn't happen. But, there's still thousands and thousands and thousands of people right now that are in forbearance. As quickly as we got those laws passed and those those things in place. It was a pretty brilliant job, in my opinion. It's out there now. The confusion, I think, has gotten cleared up. Partly our industry's done a good job of educating our customers. Excuse me. By now, you all know that, everybody has to pay back every dollar, everything that went into forbearance. But the people who did not lose their job by coronavirus and can't prove it will actually have a penalty,
Right.
So all that stuff's gotten clarified. But the forbearance rules are great because let's take the person that it's supposed to be for. Let's say I'm a restaurant manager, I don't know, at Chili's or some restaurant chain. And, so I lost my job or got furloughed for some unforeseeable future. And now here I am in month 4, and they're telling me I'm going to come back and be in my position by the end of the month and say end of month of May. So I missed 3 full months, and I contacted my mortgage, servicer back in March, and I've missed the last 3 payments at $1,200 a month. Well, now I'm going back. I call up, hey, here's the deal. I'm going back to work. I got all my paperwork to you. You approved me. I'm going to be able to make my payment on July 1st. All right. So I'm going to miss 4 months, $4,800. Well, again, if everybody doesn't know, please read the rules. I mean, even for a while, when you logged into Facebook, they're not doing it anymore, but they had a thing you could click on and read all this stuff. It's crazy how much information's out there, Jay. But anyway, so, now that person gets on a payment plan. It's almost like an escrow shortage. They work it out with their lender to pay back the $4,800 over, let's say $100 a month for 4 years. And so that gets paid, and then the lender gets reimbursed, and, it doesn't affect their credit adversely. And so all that stuff's gotten worked out, but it's still a big deal because with 36 million people unemployed, you've got millions of folks literally not making rent and house payments right now. And that is going to continue to have a drag on the economy. That, again, is part of that opinion I just told you why I think rates will stay and trade in this range for quite a while, months and months, and be up a quarter, down a quarter, up 3/8, down 3/8. But we're staying in this range because we got a lot of stuff to work out in this economy. But I think overall today, talking to you at this period here in late May, early June, versus when we first talked probably 2 months ago or so, the forbearance thing has been a success. The part that has not been measured yet, and see, these are the unintended consequences that are coming, is just the real impact on the economy even 2 months more from now. If someone tries to stay in, or the cleanup part of it, or, that part we don't know yet, Jay, because we're so early in it, right? Right now, it looks like it's working. Tons of people are in it.
Right.
But the coming out of it part is always where it can get sloppy, or we get the true measure of how this thing affects home buying, how it affects people's credit, how the agencies are going to look at it. Because let's take the guy or gal who is in forbearance and they weren't supposed to be, but then they don't want to make their payment. They want to let the money just be added to the end of their loan. Well, gee, I didn't know the rules. I didn't read it, whatever.
Right.
Claim ignorance. And now that person's credit report reflects the word forbearance. And, the agencies, again, they haven't determined all this stuff yet, but let's say they say, well, that's going to affect your score because you weren't supposed to do it. There's a lot of things we don't know yet.
Well,
and
one thing too, oh, sorry to interrupt. I was just going to say one thing we don't know, at least in my mind, what I'm thinking is, you've got these, what'd you say, 36,000, 34,000 lenders across the country. And, they're going to be like the way they're interpreting the rules, and then how they are dealing with their borrowers, and then reporting that information to the agencies. Like it's going to be different lender to lender. And so, we don't know how that's all going to look 6 months from now, a year from now.
Right. I think it'll be uniform in that time frame, but we still don't know what the rules are. Is very accurate what you just said. It's being written as we speak. Some of it is known. Again, the person, let's say it this way, the majority who've used this, it will work out this way, will have done it right, because it's for those people that did lose their job because of coronavirus, service industries, whatever. The person who was working, selling something at the NBA in my town, Dallas Mavericks, that lost their job immediately, to the person who was working for the restaurant chain, the airline, whatever. They got to go into forbearance. Now they get their job back. They work out a payment plan. That person's going to be fine. They've told us that, right?
Yeah.
That payment plan is going to get put in place. The lender's going to get reimbursed immediately once the payment plans put in place. Like right now, we've got hundreds of people in forbearance in our servicing portfolio. It's a small percent. We're only like 3.3%. But, they're all working out fine. The plans work going forward. The people do their paperwork. We know once they go back to work, we get reimbursed by our servicer, Sinlar, and on we go. So that part's okay. Yeah, the part you and I are both talking about will be ones that can't do the payment plan thing, didn't understand the rules right. There'll be some unintended consequences. So those are the reasons why I'm not concerned as much as I was, but I don't see like this economy is not going to be back where it was. My point is in the next few months, like it was in February, where we were at a 3.4% unemployment rate. The other part of that is because, and even though, like, let's look at the facts. I love just dealing with facts. It's like Steve Harney does with keeping current matters. Right now, we're looking at a probably negative 20 some odd percent growth rate in the second quarter. The market's already factored that in. The third quarter, the forecast with JP Morgan, Goldman Sachs, and others are -4 to -6% to maybe flat. And when did you ever think a -6% growth rate in America could be a good thing? But okay, that's kind of factored into the market. We're getting some clarity on that now as we go, because you got global markets that are going again. All the Starbucks are back open in China. All the Apple's supply chain stuff's open back up over there. So there's lots of factoids like that. But then here comes the fourth quarter. You got people like JP Morgan saying we could have a plus 19% fourth quarter, which I would love that. But do the math. That still doesn't get you back even really close to where we were first quarter or end of the year. But it gets you back to a really good place, and then setting the stage for a good 2021. Again, subject to, policy, who's in office. I mean, just a lot of things. So hopefully we're sticking with the same kind of policies. But so there's a lot out there. But again, I want to say this is so important. And the focus of this call, this is your opportunity. This is the greatest opportunity I have ever seen in my 34-year career to literally own, take, and dominate market share, Jay. I mean, you could be a $20 million producer and you're a $50 million producer in the next 12 months. If life is conditional, folks, if you make choices now to shift your message, your direction, people are looking for people who know what they're talking about right now, who can give certainty with a capital C, who can bring an A to Z reality to a process and a transaction and a certainty to a deal, as well as education. You give a realtor or builder right now the gift of what I'm describing, and they're yours. I'm watching it right and left with our people and folks that I know in this industry.
No, I think that's absolutely right. You can't. I just don't think you and I can put too fine a point on that right now. That's been a big focus of mine, as well as educating loan officers about becoming arming yourself with this information so you can become an expert and bring that to the marketplace, to your real estate agents, your builders, your other business professional business referral partners, to your prospective buyers, it's, well, you said it. There's so much uncertainty. People are it's not a lack of information, right? Like we're in the greatest technological age, information age. Information's everywhere. The problem is there's so much that it creates overwhelm. So the expert is a person who can go out and like we said earlier, you collect the information and then you're able to disseminate it via your framework, your way of speaking, and brings a level of certainty via your expertise to the marketplace. I think you're absolutely right. I don't think we put too fine a point on that.
Yeah. Well, good. I hope that makes sense. This has been, again, I just marvel at, what we've all been through in the last 120 days, 90 days, especially
Unreal.
In our country, our communities, and then specific to our industry. And many of the folks that are sales folks that, are out there just on the front lines and in the trenches, which is a difficult and challenging job, may not ever grasp what really was happening on the backside, especially in March and April. I'm glad we're through that chapter of this, but there's still some brokenness to the market. I mean, again, look at jumbo, and the Fed's not backing jumbo securities, and so therefore, good companies like Redwood. I mean, most people on this call know who Redwood is. They came out of the ashes of the 08, 09 crisis, and were this kind of cool, mortgage banking based jumbo lender, purchaser and servicer of jumbo loans that kept Chase and Wells and Citi and everybody honest, and brought competition to the marketplace. I mean, they're done. I mean, they could get recapitalized once things come back, but just with the Feds back 3 months ago saying, or 2.5 months ago, we're not going to buy and back and keep liquid jumbo securities. Boom, they were calling everybody the next day and saying we're illiquid, and then that shifted everything back to the Chases and the big banks, like I said, and they're all still doing jumbo loans, but they're portfolio loans right now. They have to keep them in house. Yes, they'll package them to sell someday again when they can go sell. But I started with that point earlier, and I don't think I finished it. Some people may not realize, like I have customers all the time say, well, why aren't y'all like Chase and Wells and everybody that they keep all their loans? And I'm like, well, they actually don't keep and own all their loans. They actually sell them all,
Right.
But they keep servicing on most of their loans.
Right.
They buy back and keep the servicing rights. Now, our company today, we're keeping 50-60% of our loans. It's been one of our strengths the last few months. We have the cash and capability to do it. We're a direct lender on all the agencies, so it was a competitive advantage. But the bottom line is, like Chase, Wells, let's go to jumbo, because these guys are still doing jumbo loans, but it's a slower process. Rates are a little higher now, and they're having to be very, very nitpicky, and they're underwriting high credit standards because they don't know when they're going to be able to package and sell them again. It'll happen. I mean, this too shall pass, as the good book says. It always does. But it could be months, before that part's healthy again. And then hopefully Redwood and others come back and we get totally back to, normal correspondent jumbo lending and all that piece. In the meantime, it's fascinating, the entrepreneurial side of our business, because of course there's tons of, thank God Fannie Mae raised the rate this year to 5.10, right? But there's lots of first liens and second liens being done. Of course, high balance is still healthy, although it got hit hard too, because some of its credit add-ons got raised pretty good weeks ago. But it's just fascinating. I love this industry so much with what we get to do for others and for our communities. But it's definitely been a trying time for all of us. And my biggest message in wrapping up here today is for the listener to take personal accountability and personal challenge on understanding why, WHY, on everything that you possibly can. Don't play the game. Don't be mediocre. Don't point fingers. Don't, oh, this, oh, that. I mean, just go find out why. Well, why wasn't my company able to do this? Or why isn't that company able to do that? Get the answers, because they're all there. And you and I both know that, Jay.
Yeah, no, I think that's a perfect way to wrap, because what you're even in that, like, because a pet peeve of mine is there's a way of asking why where you're a victim, and you are it's really not, you don't really want the answer why. You're playing the victim card, and you're complaining. What you're describing here, Jim, is arming yourself with information. You know how to write or ask the right questions to make yourself a leader in the marketplace. And you've got to ask, of course, you've got to ask questions, really good questions to do it, so that you can understand. That's such a different posture than throwing your hands up in the air and playing the victim card. You know what I mean?
Yep, absolutely. Yeah, I do. And that was very, very well said. I'm glad you said that way so everyone can hear it. Because it's complex. I mean, this is not easy. That's why we get paid well, and we get to, be very successful financially and emotionally when we help lots of people in our business. But it takes a lot to get there. And I guess that big message we're both saying is make one of your biggest quests to be build a better you, a more knowledgeable, more professional, more accurate on information and effectiveness for your clients and your family and your community by working on you. There's so many opportunities to do that today.
Well, and not only that, it turns this from being a job into truly like a hobby, something that you love to do. I mean, you and I've talked about this for years. Like, we've been in the business a long time, but we love it. We enjoy it. And so the more expertise you build, it's enjoyable. It's something that it becomes a passion in your life, not something that you just check a box and are trying to do. Hey, Jim, thank you so much, man. I know you got to go, and
Yeah.
for you to take 45 minutes out on a on a Saturday morning to visit with me and share this information with the listener, so appreciated, and just very thankful we were able to connect again today.
Yeah. Thank you, buddy. Anything that was there any other questions? Did we cover everything?
I think we hit it all. I think I would wrap
Good.
by just underlining. I wrote it down in red here in my notes, and I hope the listeners doing the same thing. Like, the greatest for you to 35 years in the business, or 32, whatever you said, like, greatest opportunity that's existed, right? And to dominate, not just to be successful, but to dominate in this industry, if you will make choices to really shift your thinking so that you can be that expert. You can bring certainty, I think you said, with a capital C, and arm yourself with information. And I just want to encourage a listener to do that. Jim, thanks again, man. Hey, have a great rest of your day. Tell your mom I said hi. And I look forward to our next chat, and we'll do this again soon.
Thanks, man. Great to talk, Jay. Appreciate you.